Hey everybody, Smart Silver Stacker here. We have got a lot to talk about today. Russia has just announced that it is cutting off the supply of gas to 2 more EU nations. We can now add Denmark and the Netherlands to the list of countries which will no longer be receiving shipments of Russian gas. Also, the EU has just decided overnight to proceed with an embargo designed to eliminate 90% of oil imports from Russia by the end of the year. I know I've been covering this energy situation in Europe quite a bit recently, and you might be wondering what all of this has to do with silver. Well, we're going to get into that in this video, and I'll explain how the perfect inflationary storm that seems to be forming in the West has quite a bit to do with energy, the conflict in Europe, and precious metals. So stick around, we're going to touch on a lot of subjects today, but I will be getting around to how all of this affects silver. So let's get to it. So today, Russia announced that it's going to be cutting off the supply of natural gas to the Netherlands and also to certain firms in Denmark and Germany. And this is coming as a result of the refusal on the part of these European buyers to make payments for gas in rubles. They stated that they thought that making payments in rubles was too risky because they'd have to be doing it in accounts that operate under Russian law. And also they're unsure of whether or not those payments would violate the EU sanctions against Russia, as the guidance from EU leadership has been very murky at best as to what exactly those sanctions entail. Denmark's big energy group Ørsted, they said that they're going to go ahead and go out onto the European market to source gas, but this is going to put a lot of upward pressure on gas prices in Europe, which are already very high because supplies there are incredibly tight. And we're going to talk about storage and supply a little bit later in this video. But this is all happening at the same time that EU leaders just agreed to an embargo on Russian oil imports, a partial embargo on about 75% of imports right off the bat, and then EU leadership saying that about 90% of oil imports from Russia will be cut by the end of the year. So of course, this is also going to have a dramatic effect on energy prices in Europe. And that means in the US as well. We are going to see energy prices move up as a result of this here, because we're going to be exporting more and more energy to the EU, and energy markets around the world are just going to get a lot tighter. Of course, I've mentioned in previous videos, that's not the case all around the world. You know, places like India and China are actually going to benefit from this. They're going to get cheap energy, but in the West, we're going to see the opposite, much higher energy prices as the supply continues to diminish. And we're already seeing the effects of this in Germany, for example, which just had inflation come out at the highest level in nearly half a century. They recently had an inflation print of about 8.7%, and that was against expectations of 8%. And this is as energy prices and food prices begin to skyrocket, and I think that is a trend that we are going to continue to see. Adding on just some additional inflationary pressure, we're seeing Germany just announced today that it would be spending $107 billion, or the euro equivalent, to modernize its military. And of course, they're going to be borrowing that money and spending it into their economy, and that is going to increase the inflationary pressures in Europe, as a number of these NATO members in the EU are going to have to be taking similar steps. Now, something that I wasn't aware of before this conflict kicked off, and it's something I suspect a lot of people aren't aware of, is that the Ukrainian military, which Russia is currently fighting, is actually in a lot of ways vastly superior to the militaries of these other European countries. And to give you an idea of what I'm talking about, we can go over to this website, globalfirepower.com, which gives us a ranking of the number of main battle tanks. Now, this is just one statistic, but it's an important one in a land war, and it kind of gives you an idea of just how much money European nations are going to have to spend if they want to get their military up to par. You can see Russia here in the #1 spot with over 12,000 tanks. Now, the US with about half that number, but you know, keep in mind, the US is primarily a naval power and Russia is primarily a military geared towards land warfare. So, you know, that explains some of that deficit here in the US numbers. But if you want to find Germany, for example, since that's who we're talking about modernizing their military, you've got to go down to the 55th position. And you can see Germany here has 266 tanks. Now, Ukraine, they're not doing too bad. They've got about 2,500, still only a fraction of what Russia can field. And, I saw some news stories the other day about how Russia's lost 1,000 tanks. Well, okay, I mean, so maybe they've got 11,000 tanks now, but that's still a lot more than these European countries can field. France, we can see they're in the 36th position. They've got 406 tanks. So these European countries, these NATO members in Europe, in the EU, they have had their militaries hollowed out since the end of the Cold War. I mean, they've basically exported and outsourced their defense budget to the US. They rely very heavily on the US for defense, and they're really not in a good position to defend themselves. So to the extent that they want to remediate that problem, we're going to see a lot more spending on the part of these countries, and all that money is going to be borrowed and spent into the economy. And this is all going to come at a time that economies are already experiencing high inflation. We're already heading into recession. So, this is not good. But one of the most powerful inflationary forces you can have is war, because it requires a tremendous amount of spending, a tremendous amount of currency creation and borrowing, and that is what we are beginning to see. Now, we are going to talk about how all of this is related to silver, but first, real quick, I do just want to say a big thank you to today's video sponsor, Silver Botanicals, personal hygiene and household products that utilize the power of nano silver. You can check them out over at silverbotanicals.com. There's a link down in the description, and don't forget to use coupon code STACKER to save 10% off of your order. Now, one of the things that Danish energy group Ørsted was saying was they're going to go out onto the energy market in Europe and buy gas, and also that there's no reason to have any immediate fears of gas supply being disrupted because they have stored some gas in anticipation of this. Well, maybe they're storing gas, but the situation in Europe at large as far as gas reserves and gas storage is not looking good. This is a headline that came out yesterday about one of Europe's largest gas storage sites and how it could start winter empty. That is not what you want to do heading into a European winter. And this is referencing the Heideck gas storage site in Austria. It's one of the largest in Central Europe. Right now, this storage site is at about 30% capacity, but that number is actually declining because the only source of gas for this gas storage site is a subsidiary of Gazprom in Germany, which has now had the supply of gas cut off. Now, the EU, understanding that more gas disruptions are coming, has set a target to try to have 90% of their gas storage sites full by the winter. But I don't think that they have a chance of hitting that. Right now, the average for European gas storage is about 46% capacity. Places like this Heideck site in Austria, the number is falling because there is no more gas coming into that site. And so this winter, we could really see a perfect storm for energy prices, and it's not just going to be in Europe. The source of the issue might be in Europe, but we are going to see this bleed over into the US as well, and we are going to be getting much, much higher energy prices here as a result. One of the ways that Europe is trying to remediate this gas crisis is by doing exactly that, importing more gas from the US. Here's a headline from Petroleum Economist, and this article is discussing how sourcing sufficient liquid natural gas for Europe is going to be very challenging over the coming years. And that is Anatol Fagin warning of that. He's the CCO at U.S. liquid natural gas exporter Cheniere. The problem is that we just don't have the infrastructure in place to ship all of this liquid natural gas to Europe. There's bottlenecks along the way. How much gas you can convert into a liquid, how many ships you have to ship it, and then really the biggest infrastructure problem in Europe is the ability to distribute that gas, because all of their infrastructure is designed to send gas from the east in Russia westward. And what we're talking about now is switching that to get gas into ports on the west coast of Europe and send it east. And that's going to require a lot of retooling, a lot of changes to the infrastructure, and all of that takes time. And in that same vein, we got this story from Reuters yesterday about how Israel is actually increasing their gas exploration, and they're looking at export deals to Europe. So Europe is looking to get gas from any friendly source because, they really need a tremendous amount of gas. They rely on Russia for 40% of their natural gas imports. It's not easy to replace. But this article, the gist of it is just that Europe is looking for Israeli gas. But the article finishes up by saying officials have said it would be at least a couple of years before significant amounts of Israeli gas could reach Europe. So these supply problems are not going to be alleviated overnight, and they're not going to be alleviated before winter hits. So this winter, we're going to see some really big energy issues stemming out of this European energy crisis, and it's going to affect us too. Now, why does all of this affect silver? That's the big question. I'm sure all of you are wondering, why is this guy Smart Silver Stacker talking so much about natural gas and Europe and energy and all this stuff? Well, take a look at this chart. This is the silver to oil ratio, the historical chart going back 30 years, and you can see there is a fairly predictable range and a fairly predictable pattern on this chart. And excluding a few of these outliers here, like in 2020 when we saw the ratio spike up to 0.79, in 2005 spike down to 0.1, typically you see it trading somewhere between the range of 0.5 and 0.2. And we are at the very low end of this ratio right now, 0.19. This chart oscillates very predictably, and so what you would expect from this level is for the ratio to bounce. Now, there's two ways that that could occur. You would need either the price of silver to appreciate significantly, or you would need the price of oil to collapse. And to give you an idea of what I'm talking about, in order to get back to that ratio of 0.5, we've got a crude oil price today of about $115 per barrel. In order for the ratio to get back to 0.5, if the price of oil were to stay where it's at, you would need to see a silver price of almost $57.50, more than double where it's at today. Now, of course, like I said, the price of oil could fall, but I think that that is extremely unlikely given the confluence of factors in the economy at the moment, which seem to be telling us that energy is going to be moving much, much higher. Now, how high could oil go? Well, here's an inflation-adjusted chart of oil for the past 20 years, and you can see that back in 2008 was the previous high. Now, if you adjust that high for inflation, as has been done with this chart, you can see that the high end of the chart was about 185 bucks. So plenty of room for oil to continue moving up from where it's at now. And let's say that oil did continue to move up and it got up to about $180. Well, in that case, if we were to get back to this ratio of about 0.5, you would need a silver price of $92.50. So a drastically higher silver price relative to energy. And you know, today with silver at 22 bucks, considering the rampant inflation and the supply bottlenecks, it does seem extremely cheap. You know, given the uncertainty in the economy at the moment, silver as a traditional safe haven seems like it is just on fire sale at 22 bucks to me. And this chart here of the oil to silver ratio, I think indicates that we could be seeing much, much higher silver prices. And it makes sense because as energy moves up, you know, other commodities move up as well. Silver's no exception. You need to use a lot of energy to produce silver, to dig it out of the ground, to refine it. So, you know, if that becomes more expensive, that's going to put upward pressure on the price of silver. And I think that as more and more investors come around to what is going on in the economy and the kind of inflationary trouble that we are in the West, silver and gold are really going to become much more appealing to investors. Investors are going to begin to bid those assets up. And that's why I'm going to continue to acquire physical metal at these prices. Now, if we see this ratio adjust, you know, if we go back up to the 0.5 level, that might be a sell signal for some for silver. I probably wouldn't be selling physical silver at those prices, but you know, I own some mining shares and some more speculative assets that are related to precious metals, which also at this point are extremely cheap. I mean, miners pulling silver out of the ground and gold out of the ground today, you know, the market has really discounted them quite a bit. And I think that there are some screaming deals there. None of this is financial advice, of course. I'm just a guy on YouTube. Always do your own due diligence. I think that the ongoing energy crisis in Europe is going to continue to worsen. And I think that it's going to put a lot of pressure on commodities, including silver and precious metals, moving forward, and that's why I think that really these prices are just extremely cheap. Let me know what you think in the comments below. And also, you know, if you like seeing these videos where I talk about kind of the broader macroeconomic sense, if you appreciate those, give me a thumbs up. Let me know if you'd like to see more of these videos. Thank you all very much for watching. Don't forget to like, comment, and subscribe, and I'll catch you next time. Smart Silver Stacker, out.